Hey everyone, welcome to Retire with Style. I'm Wade. I'm here with Dr. Alex Murguia, and we're going to begin an arc on alternative investments.
Thank you,
But,
Dr. Pfau.
but before we do get to that, I finally have played my first game of pickleball against Alex, or with Alex. Actually, we're on the same team for much of it, and I didn't realize how good Alex was. But yeah, I'm no longer a neophyte when it comes to pickleball. I play it a lot like I play ping pong, which is more defensive. Try to just consistently return things and wait for the other person to try to slam it and make a mistake, which can work against lower level players, but it's not going to get me too far up the rankings, I think.
Well, actually, Wade, you're saying something interesting, and not the fact that I'm a far superior player. No, you're saying something interesting, and that's I don't know if you're familiar. You familiar with Charles Ellis, famous investment writer?
Yeah, the madness of crowds or something
No,
along
no,
those
he
lines.
wrote "Winning the Losers Game,"
Oh, okay.
and in it, what I think the wisdom of the crowd is I want to say it's James Cherwalki. I'm gonna mispronounce his name, but something like that. But Charles Ellis, he wrote "Winning the Losers Games," and he was a big time tennis guy. Just to throw this in there, and so I believe the preface of his book, he's talking about how tennis and investing are similar in the sense of in tennis you can either go for winners. Their style of folks go for winners, or some people are pushers, where you just get the ball back, get the ball back, get the ball back. And he was pointing out that other than the high levels, just getting the ball back is actually a fairly effective winning strategy for 99% of the folks out there. Maybe it's not 99, maybe it's 97.3, but that kind of thing. And I think there's and he's drawing parallels to investing from the standpoint of you don't have to go for the home run ball, just slow and steady wins the race.
Mm-hmm.
And he's comparing tennis to investing in the sense of just tennis. Just make sure you get it over. Make sure you get it over, because most likely the folks you're playing against, unless you're on the ATP tour, you don't have to worry about anything else. Just get it over. Don't be the hero. You see how that there's parallels to that with investing.
Yeah. A lot of people go for those home runs and they consistently just miss the court. So
Yeah,
if you can just return it, it's
and frankly, you just mentioned pickleball to make small talk, but really it's a great transition, because the reality is that in alternative investments, we're going to do a whole arc on alternative investments, right? And the reality is you have to first ask yourself, is this needed to quote unquote win the loser's game? All right, winning the loser's game. And I go back to your research in the sense of people get too caught up with things, and the reality is the sustainable withdrawal rates are usually just based on a standard 60-40 S&P risk-free rate type of portfolio, and it kind of gets the job done. And by no means am I trying to lead the witness by saying just do that and call it a day, or go to alternatives and call it a day kind of thing. I just want to kind of point out it's interesting how there's many ways to get this right.
Mm-hmm. And a big part of that would just be, right, do you even want to consider alternative investments? But I
Yeah.
suppose an even bigger first step is, can you tell us a little bit about what alternative investments actually are in the
Yeah, no, we'll
context of
get to that.
investing?
Before then, since you did talk about pickleball, and I was kind of leading to start the podcast, but not so fast. We're creating our Retire with Style pickleball paddles. And part of this is just, in retirement, what are you going to do, right? Play pickleball. Hell, not even in retirement. But we wanted to, kind of engage our community. So, I got my kids to actually set up an entire entity to create pickleball paddles, so we can kind of begin to promote them for us. And they'll do it for like high schools and things like that, like branded pickleball paddles. But they're doing some for us, and we've created them. And so, if you don't mind, in the show notes, we're going to have a link of 2 paddles that we've created, and vote on them. And every episode what we'll do is we'll see who voted on them. We'll have a timestamp for, per episodes, and we'll give one away, right? But vote on which one do you prefer, and this will help us with our production quantities, if you will. So if you don't mind, in the show notes, just click on the link. We'll have a picture of the paddles, where you can pick which one you prefer, and we'll take it from there, and there'll be one lucky winner for a paddle, and these are legit paddles. I've gone down that rabbit hole, and so for me, these are easily based on the quality of construction, the specs, and things along those lines. $180, $225 paddles, and so yeah, we're going to use them as promotional items, frankly. But pick which one you like, and we'll have a winner with each episode based on the poll, and paddle will be yours.
And those with good memories may recall Alex actually showed them on the previous episode with the YouTube version of the podcast. He has since lost the paddles, so he's not able to show
Well, come on, Wade.
the prototype.
What happened is we had last 2 days ago, Wade came to DC. We had a company event for like the McLean Retirement Researcher and RISA. We got everyone together and flew everyone in, and we had a big company event at Tyson's Pickleball Paddle Club, and it was awesome. It was great. We brought out the paddles there, and Wade, I know I have them because afterwards I was driving Wade to the airport, and we stopped at a park to get some more reps in, and we had the paddles there. So they're around. I suspect my wife sort of probably saw them in the house somewhere thrown around, and said, "What is this mess?" And it's hidden away in some closet or something. So I did not lose them. They're in here somewhere.
And I think they're still in the car. You just didn't bring them in the house.
No, I checked before the podcast. Remember how I said, let me go see if I can find them? I didn't see them in the car.
All right.
And incidentally, do not leave pickleball paddles in the car, especially during the summer. They'll delaminate. The core, the carbon layer will most likely become unglued to the core at extreme temperature. So
will it turn into diamond?
Wow, look at that. Carbon, yes, I got that way. Thank you. No, it'll turn into mush. It's inside. It's usually a polypropylene core, which is plastic, and it'll just like get warped. But our paddles won't, because they're foam. They're all foam inside, so it's cutting edge, Wade. At 120 density. So, like I said, I went all in on this sort of pickleball paddle rabbit hole. But that's not what we're about, right? This is alternative investments.
Okay, so alternative investments. And you've really been boning up on this topic as an investments person and doing workshops with the Retirement Researcher Academy. So it's a great chance to also share that knowledge with a broader audience.
Yeah.
So what are alternatives?
That's a great point. And just to give people, wait, what do you mean we've been boning up? On Retirement Researcher, that's our membership site, where we really get into specific topics. And it's geared for a lot of do-it-yourself investors that, obviously, while we have McLean Asset Management as our traditional wealth management firm, we realize a lot of folks like to do it themselves and learn. And many of them are listening to the podcast. And what we've done is we've tried to create Retirement Researcher to be kind of a masterclass for all things retirement income planning. And in that vein, we've been doing a series of workshops on alternative investments. And based on the popularity of it and the feedback we've got, and Wade and I figured, you know what, we should do an arc on the podcast on this, because if those folks are interested in it, it stands to reason that our listeners are as well. And so what we'll do is we'll take snippets of that and present it in the podcast over the next let's say 3 to 4 episodes, if you will.
Yeah, and anything, especially with this time of market volatility, finding assets that aren't necessarily correlated with assets exposed to significant downturns and creating broader diversification. What are alternatives?
Yeah.
What's the justification? What are we getting into here?
Yeah, I'll get to that. And now, with just as a caveat warning here, if you will, by no means are we espousing, hey, everyone, invest in alternative investments, or hey, don't invest in alternative investments. The job that we're going to take on here is just to help you become informed consumer. At the end of the day, this is not an endorsement. This is not the opposite of endorsement. It's just, as best as we can, lay down the facts and for you to make informed decisions of. Obviously, if you have any questions, feel free to give us a holler, contact us, etc. But for the most part, we're just laying the groundwork here as part of, hey, this is what it's about. And Wade, alternatives. It goes back to what we were talking about at the beginning of the podcast, winning the losers game, and there are many ways to kind of get this right. And I've used this before, but think about when you're bringing in asset classes to a portfolio, you have certain primary colors, and at the end of the day, you're shooting for a color, a combined color, and you make that with primary colors, like yellow and blue make green, that kind of thing. And so whatever the green is for you, it's preference. It's whatever style you like. That being the case, alternatives could potentially be one of the primary colors. You may not need it to get to the color you need at the end of the day. So by no means, just because we're presenting this, is that hey, let's get this, because there's so many things to invest in, right? And if you decide to invest in everything because they're quote unquote investable, you may end up with a portfolio that's just muddy at the end of the day. So the caveat is, this is just from an informed standpoint, because we have we come across a lot of prospects that come to us, and when we look at their statements, they have alternatives, and a lot of them don't know what role that they play in the portfolio, what it even is, and the like, because it's this broad statement of alternatives. And that's where things get tricky, in the sense of there's a broad statement of mutual funds. There's many types of mutual funds. Some are conservative, some are aggressive. Broad statement of ETFs, right? And so to some extent, alternatives, I view them in those lights, especially when you hear the word hedge funds or private equity and things like that. What is that? What's the underlying subcategories of those? And that's what we'll be getting into in this series. But to begin with, alternatives, Wade, is really an alternative to stocks and bonds, is what they're getting at. And so, as you can imagine, that's a pretty broad universe to do. And so the definition of alternative is meant to be more of an anti-definition of what it's not, right now. And so alternatives are considered what aren't stocks or bonds. It's kind of the way that it's being used right now in the nomenclature. But
Got
is
a
it raining?
thunderstorm here. That was
Wow, wait, that's amazing. That must be really loud, because
yeah, picked up on the microphone.
when you say you're having yard work done and stuff like that, you don't even notice.
That was a
So
loud
yeah, that's amazing. Be careful.
storm in
So
Dallas.
effectively, over the last 20 years or so, there's been a huge sort of interest in this. In this, and it all starts with institutions, endowments, and then it begins to trickle down and trickle down and trickle down, and we're at that point that it's really starting to trickle down to, let's say, the most common denominator investors. Not there yet. There's certain vehicles that sort of present the opportunity to do that, which we'll get into. But alternatives is what's not. It's considered right now, the quick and dirty definition is really anything that's not a stock or bond that you can quote unquote invest in, right? Now, it's a broad brush, because that can include private equity, and under private equity, there's a subcategory of what those are. Private credit, underlying that, there's subcategories of what those are. Hedge funds, under that, subcategories of what those are. And real assets, under that, a subcategory of what those are. And so,
And
for
just to clarify too, this is usually a term used more in the accumulation world. So in retirement income, you might think of annuities as alternative investments, but that's not really what we're getting into.
That's a great point here. Where because an annuity is ultimately a private contract, right? And so, and it behaves differently than stocks and bonds from a return standpoint. Well, it's not even a stock or bond from a return; it's really an insurance product, but it behaves differently. So yes, Wade, you're right, but that's not how we're using it right now.
Whole separate arcs on annuities.
Yeah, we've had many arcs on that one, right?
They're not part of today's alternative investments conversation.
Thank you. And yeah, historically, they've only been accessible to institutions because there haven't been interlocutors to sort of provide access. And the reality is, someone with 50 grand wanting to put it to work in private equity 20 years ago, those calls wouldn't be returned. Whereas an institution with 50 million looking to put to work, those calls will be returned, and they'll have a dinner and etc. But the reality is, new structures are allowing more and more individual investors to participate.
And why might they want to do that?
Well, it's a very cool thing to say at parties. To be able to say I have
That's not you.
alternatives. You know, when someone's talking about the S&P 500 index and how they just leave it there and forget about it, to be able to say I also have private equity, that's a flex move. No. They do it simply because I mean I'm gonna discuss why they do it. I'm not gonna say that that's a correct assumption and that's not a correct assumption, etc. But the answers that you will see, and frankly, if you have an advisor, they're going to pitch you on this. These are the buzzwords that you'll hear, and that's there's a potential for higher returns. There's enhanced diversification benefits. It has the ability to potentially hedge against inflation and market volatility. You know, at the end of the day, alternatives provide this opportunity to enhance returns while reducing the overall portfolio risk through diversification. That's kind of a nice way of putting all those bullet points together into one sentence. Whether it does or not, it's subject to the person doing the analysis, if you will. But that is the thesis of why would you seek alternative investments. Now, why does it reduce the overall portfolio risk, etc.? And these are things we'll get into throughout the arc, but you'll get statements like they have a lower correlation to the public markets, meaning they may perform well, you know, when traditional stocks and bonds are struggling, like, you know, perhaps this past month, if you will. Now, there's many counters to that, such as they're not priced every day, and so there's a lag, etc., but that's not right now. This is more the setup of what you're hearing. Everything that I say there will be counters to that we'll go over, but I'm giving you the thought process behind it. The other piece on the inflation side, they'll say, you know, many alternatives like real assets, real assets being commodities, real estate, infrastructure. And by real estate, it could be residential, but it could also be like forestry, you know, things along those lines. You know, they'll say they provide a hedge against inflation. And in today's economy, that's kind of a relevant pitch. So think about it. What's happening right now? Markets are extremely volatile. If someone is presenting you, hey, you know what? There's nothing I can do about stocks going down when they're going down at this level or even up, because we've just, as of this recording, I think the markets have been up 8 days in a row, something like that. Something that hasn't happened since like the year 2020. So something crazy like that, right? But they'll say you need something that doesn't correlate, that acts independent of whatever the stocks or bonds are doing, right? You can check that box of a story being told right now. You can also check the box that, hey, you need an inflation hedge. Look at gold going gangbusters right now, right? That's an inflation hedge. That's a hard commodity. But you can see someone saying that with real estate as well. And so that's the storyline why folks would seek alternatives. Frankly, higher returns, diversification benefits, and the hedge against inflation. And I know I said it earlier, kiddingly, but there is some truth to be able to say, hey, I'm behind a velvet rope and I have access to this and you can't. It's just almost a human nature thing where, I mean, Daniel Crosby said it and I was making fun of him about the hedonic treadmill, you know, keeping up with the Joneses, where you kind of always want that. And although we may not admit it, you know, outright, in your heart of hearts, I think many people just like the fact that, hey, I get something that you don't, so look at me, I'm more sophisticated than you. As stupid as that sounds, Wade, I think there's an echo of truth in that. Am I off on that?
Yeah, the whole idea of conspicuous consumption. The hedonic treadmill may not apply. That's more once you improve your lifestyle, it's hard to go backwards again. So you're
Oh, is that
better
what that is?
off.
Oh, then I got it wrong. I thought that was like keeping up with the Joneses kind of thing. Like always need more, you
Well,
know.
once you get an uptick in lifestyle, then you have to keep getting more upticks because the great opportunity you had with this higher lifestyle quickly dissipates. So you got to
Okay.
just keep getting
Then
more and
thank
more.
you, Wade. Always
That's
adding value.
yeah,
And so
conspicuous consumption.
I mentioned it earlier. The core categories are things like private equity, private credit, hedge funds, real assets. Now, under private equity, and these are things that we will really drill down on.
Well, before
But
you mention that, you have not mentioned cryptocurrencies. Is that not part of the?
oh, yeah, there is, but that's new, and I think we'll give it its own treatment, frankly, at a certain point because it's just so hot right now. But yeah, I would say cryptocurrency could be considered that, especially with regards to Bitcoin, which is seen as an alternative to, like, let's say gold or safety. But when you talk about Ethereum and, let's say, Ripple and things like that, it's almost like technology plays with regards to new innovations, where like Ripple's trying to take over Swift, right? The Swift way of wiring money, things like that. I think it's a little different in the sense of, yes, it's not like a stock or bond, but is it quasi like it, like, is every coin like its own little ecosystem of a stock, kind of thing. And so I want to give that its own treatment later on. But yeah, I mean, the main ones are, like I said, private equity, private credit, hedge funds, real assets. You're right, crypto is one, but I don't want to bunch it into right here because it's almost its own beast right now in and of itself. And like under private equity, you're talking there venture capital, growth equity, buyouts. Under private credit, there you could be talking about direct lending, mezzanine finance, distressed debt. Under hedge funds, you have a lot of types of hedge funds. That could be long short hedge funds, global macro hedge funds, event driven hedge funds, market neutral hedge funds, managed futures hedge funds, which could be a cousin of real assets, except managed futures hedge funds are largely trend following strategies. It's just commodities have so much volatility that it's kind of a nice play to use them. Real assets, that to me is actual real estate. Real estate is commercial real estate, residential real estate, etc. Infrastructure plays, if you will, like data centers, prisons, things like that. Commodities, there you have the standard hard metals and the like, but expand, amplify what that could be when you're talking about farmland, when you're talking about timber, when you're talking about things along those lines. And so all of those to me are nice, sort of a nice alternative bucket, if you will.
Okay. Could you talk a little about the history in terms of how we're seeing this trend increasingly where household investors may have opportunities in this space that historically may not really have existed?
Yeah, I mean, I think this is the way things go naturally. It's like that phrase, the future's here, it's just not evenly distributed, if you will. And dating back to, let's say, 20 plus years, this was, endowments started really, and before then, but let's just say for argument's sake, endowments really started getting all in on it. I would say the person that really brought this to the forefront to to the everyday investors, in the sense of what's going on here, what are they doing, how are they doing it, why are they doing it, would be David Swensen. He passed away a few years ago, but he was an innovator in terms of just managing endowments, and he did it for Yale, and he was sort of the Warren Buffett, if you will, of endowment investing. And they structured their endowment to be heavily, heavily weighted to private equity, hedge funds, real assets, leading to far superior returns than the standard 60-40 portfolio. Now, you have to understand, that's an endowment that's multiple $1 billion. They go directly to the venture capital firms in Palo Alto. They go directly to private equity funds. They don't, they don't kind of have an intermediary to have access to these things. That's something that you and I wouldn't be privy to. So, but it started like that, if you will, with institutional money really putting their money to work, if you will. And many of them had great success, and genius steals, right? And so folks started saying, hey, how do we get in on that? How do we get in on that? And then whenever there's a market for something, whenever there's a demand for something, people figure out a way to facilitate those, the participation in those. And so that's really how it starts. Years go by, it ebbs and flows, and we are where we are now with regards to, from top down, the institutional folks, the ultra high net worth family office folks, the high net worth folks, and the like. Now, it's still a high net worth thing, but with technology, there's many ways to facilitate the ability to invest in many of these vehicles just through standard interval funds or ETFs and things like that we'll get into as we progress.
And maybe while we're on the same topic, there's this idea of being an accredited investor. to have access to these types of opportunities? Could you talk a little bit about that? And
Yeah, no, that's a good point. Who qualifies for certain alternatives? Because this is the other piece. Like, you can't just pick up the phone and say, "Okay, I'm in," or go log into your Charles Schwab account and say, "Hey, you're in," right? And so, from that standpoint, an accredited investor, who qualifies for alternatives? Institutional investors. Obviously, that includes pension funds, insurance companies, banks, university endowments, sovereign wealth funds. If you're not one of those, I wouldn't call yourself an institutional investor. Accredited investor are high net worth individuals who meet certain criteria of net worth and annual income requirements. I'll go over that in a second. And, in addition to that, you can be an accredited investor if you have qualifying investment knowledge based on your profession. So let's say I don't meet any of the quote unquote criteria to be an accredited investor from a income standpoint, from a net worth standpoint, or whatever. Being that I'm in the business and we're running McLean Asset Management and the like, I would consider myself to be, to have qualifying investment knowledge based on my profession, and so would somebody, that's looking for an investment. The other one are qualified purchasers, or these are defined as individuals that, that have 5 million or more in investments, or entities with 25 million or more. Those are the sort of hurdles. Now, what's an accredited investor, if you will? Again, this is important. And to me, an accredited investor is someone you qualify if you meet the following wealth and investment criteria knowledge. Wealth, you need to have a liquid net worth, just a net worth of $1 million or more that exclude the value of your primary residence. Individually or jointly with your spouse, right? So you need $1 million or more in assets, not counting your house. Income. Individuals with an income of 200,000 or more for the past 2 years, with the expectation that that's something that's going to continue going forward. If you have a spouse, the watermark is 300,000. Right?
And this is an either or. You don't need both income and
Yeah,
wealth. One of those.
Exactly. Investment knowledge. If you listen to this podcast, you're in good shape. Just kidding. Wait, that was a late reaction. No. Investment knowledge. These are investment professionals. If you don't meet the above, could you still be accredited? Well, if you're an investment professional, you can, but you have to show that you have something that says that you have knowledge. And so that would include some sort of licensing that you have, such as the Series 7, Series 65. I believe the next one is Series 82, something like that. Or persons affiliated with the fund, including employees, directors, officers, or general partners. So if you're there, you're in good shape. But again, why, I want to stress enough, why would you even do this? Again, it's because low correlation to public markets, potential for higher risk-adjusted return, and understanding that the risk-return piece of it has to do with liquidity trade-offs that you're making. And that goes back to, the why they want accredited investors, because you don't want to purchase something or participate in something, and then 3 months later say, oh, I need the money because, I don't know, my roof caved in and I don't have any other assets to pay from it. You may be stuck in a lockup period. And then you'll say, oh, I didn't know that. And so it becomes one of these things that were you savvy enough to know what you were doing before you got in it? And that's how they assess you being an accredited investor. And that also avoids, you can imagine, there's good and bad in everything. And if you have enough of a sample size, you'll have a normal distribution on morality. And the reality is that some people will take advantage of others simply because they don't know what they're doing under the auspices of, ooh, they want alternative investments. Let's sell them this. They'll be happy to buy it, that kind of thing. And so in its wisdom, the SEC feels that accredited investor status is the way to kind of, have some sort of level of checks and balances.
So does that just generally mean these aren't available in brokerage accounts? Like if I log into whichever big brokerage I may be using,
No, you can. There's certain types in everyone, like Schwab, for instance. Even though I said that the minimus here for accredited investors is $1 million, I want to say Schwab is significantly higher than that. Like if you just log into your Schwab, institutional account or whatever, and you look for alternative investments, first you have applications that you have to sign, like similar, like if you wanted if you wanted to do options or a margin account, things like that. There's an extra step that you would need to have access to it. And I believe their watermark is much higher than $1 million. I would put it in the $3 to $4 million range, I think, but I'm doing that from memory. It's higher on an order of magnitude more than just the basic $1 million of net worth. But you could potentially do it. Not probably every type of alternative that's out there. I'm not so sure everyone's doing crypto right now, but you can do. I'm sure hedge fund strategies are available. I'm sure certain private equity strategies are available that you can get direct through Schwab. But again, there are higher minimums, if you will, than what's considered accredited investors. Why do they do that? It's a hassle logistically and administratively to process all of that. And for them, they're like, someone in all their wisdom decided it's probably not worth the compliance risk to make these very readily available to everyone. That would be like my no frills answer.
So then on that sort of theme, like what sort of myths or misconceptions are there about alternatives?
Well, I think it's about risk adjusted returns. And people throw out, and this is my hat on that, there is value to consider this, and there is value to look into it and do due diligence. It's not like baseball cards and you're like, forget that. You know what I mean? I mean, a lot of people just say alternatives are too risky. Alternatives is such a broad term. As I said, it's everything that's not stock or bonds. And there's many alternatives that are actually quite more tame than investing in stocks. Maybe not all types of bonds, because, a 3-month T-bill is hard to beat from a risk standpoint. But when you consider risk-adjusted return, which is how you should be looking at it, then things change, right? So just a broad brushstrokes alternative are too risky. I think that's mentally lazy. I think you really have to look at it from a wider frame, and that wider frame is risk-adjusted returns, because I think alternatives run the gamut of being quite risky to some being very conservative. The other one is, it's only for institutional investors. Yeah, I think that was practically the case, even up to 5 years ago. But the reality is that there's, with technology is a great thing because it really begins to democratize accessibility to certain items, right? The information asymmetry becomes less or less. That becomes less and less. Markets, demand develops for certain types of things. If demand is there, people all of a sudden get creative and innovative in how they can facilitate that matchmaking process of matching a buyer to a seller, if you will. And so that process is ongoing right now, and you're seeing that, through the increase in retail access. I mean, there's a couple of behind the scenes firms that are worth billions of dollars right now, like CAIS and the like, in which they're actually making for advisors these platforms so that they could offer to their clients, alternative investments. And, they're white labeled by large brokerage houses doing that, but even registered investment advisors like ourselves can do that. Just because you can do it doesn't mean you should. I'm just sort of providing the misconceptions, such as they're too risky. That's a not so fast kind of statement. Only for institutional investors. That's becoming significantly less and less, not more and more. And high fees is another misconception. Not misconception, I would just call it conception, because I would say that's probably was an accurate conception a few years ago, where hedge funds are charging 2% and 20% of the profits in addition for what? Kind of thing. And so you're seeing, again, markets work. When there's increased demand, there's actually more players trying to provide that service. When there's more players trying to provide that service, there's fee compression, if you will. Now, you can make the case that there's another trend happening where people are identifying, especially with hedge funds, that it's not really this manager skill. What they're doing is really finding premiums in the market that are available for the taking. And if you can develop systematic strategies, systematic being, that's code for kind of indexing. If you can develop indexing robotic trading strategies to what this manager was doing and capture systematically that quote unquote premium, then we don't need to charge that much, and we can replicate it. So you're seeing that a lot, and a lot of players coming in, which I think that's a good thing. Replicating strategies, and alpha becomes quote unquote beta, if you will. And that's the trend that you're seeing. And with that, you're naturally going to see fee compression in the same way that actively managed mutual funds, are anchoring down, simply because an active managed mutual fund charging you 1.5 is not going to compare with an ETF that's charging you 5-7 bips. And that's 0.05, 0.5 of a percent as opposed to 1.5. So you're seeing this huge trend in a manner that's creating a nice sort of on-ramp for individuals. And again, just because there's an on-ramp for them doesn't mean they should do it. I'm just saying that the time is getting there where all these sort of conceptions that you had previously, such as they're too risky, they're only for institutional investors, or that the fees are just egregious, I think it's time to reconsider those assumptions in a major way.
So now, and then as part of that, like, there are now mutual funds and ETFs that replicate some of these strategies that traditionally might have only been available through hedge funds. So that's also making it more widely available, but you do still need to meet that accredited investor definition.
Absolutely. Now, no, but some ETFs, begin to. There's some funds that are out there that you can just pick up as an ETF, but they wouldn't be. That's a different game. There wouldn't no longer be these like, I'm a partner with within some sort of private equity Apollo fund number 3, kind of thing. It would be more, you can have access to an interval fund, an ETF, and stuff like that begins to replicate these. Then the accredited stuff is more relaxed. But there's still structural considerations you need to consider. And what you really want to look at, and I think this is actually one of the most important ones, is just liquidity versus illiquidity of what you're getting. Because these are private funds. Again, they're no longer like daily liquid sort of ETF mutual funds, although there are some alternatives that are getting there that we'll go over. But for the most part, you want to consider liquidity versus illiquidity. I'll give you an example. I had we picked up a client a few months ago, high net worth, and the percent that came from one of those large brokerage companies, and the percent that this person had in like a private equity participation was de minimis. I mean, like not even 1% of his portfolio, right? And he transferred that assets over to us, and he couldn't transfer the alternative piece because of the way it was set up. And he couldn't like liquidate it either because of the way it was set up and the like. He has to wait 3 more years, right? And so the reality is this is an insignificant part of the portfolio, will not really move the needle in any way, shape, or form. And it's 80% of the nuisance of the portfolio. It's like the 80-20 rule the other way around of what you don't want, right? The how do you spell Pareto backwards? How you need like is it a palindrome? No, whatever it is. It's palindrome is when the same is like radar or something like that.
Forwards and backwards.
Yeah. And so it's just one of those weird things that it's a headache. And so you really want to look at liquidity versus illiquidity, simply because sometimes it's just not worth the aggravation, right? And with that liquidity comes like, are you locked in for future? Do you have to give more commitments, over time? What happens if you don't do that? And this goes back to your initial point. Are you in the accumulation or distribution, right? If you're in the distribution phase, I would give significantly more weighting towards liquidity than illiquidity. If you're in the accumulation phase, you can be a little more relaxed on that, but still, it's one of those things. Regulatory oversight. This is important because some folks, anyone's that, if you're going to invest in this, most likely there's some sort of subscription document and the like, and there's quasi oversight, but the reality is not really. And so you want to make sure that there's some regulatory oversight around this. I mean, some of these funds aren't audited. Some of these funds aren't priced on a daily basis. And so you want to make sure that there's oversight in them, simply because you don't need the aggravation. I'm going under the assumption that the main crux of your portfolio are going to be stocks and bonds. And this is sort of complementary pieces. And so if it's going to be a complementary piece, you want to make damn sure that there's oversight to this, because if not, it's just not even worth the aggravation at all at that point. Access and minimums is another structural consideration. When you're trying to create a portfolio and you want to know how much of the allocation to put in this and that, what are their minimums? Because you may identify this great alternative, but if the minimum is $5 million as a commitment and your entire portfolio is $6 million, well, I think you have your answer in terms of where you're going with that. And so you want to give those structural considerations a strong play in that. And the only piece here is many people will say liquidity and illiquidity is very important, because not only is it a basic structural consideration, but it's potentially one of the sources of returns. And what I mean by that is there could be a liquidity premium. If you're locking your money up for 5 years in this special interest fund, one of the reasons that you should be expecting a higher return is because you're committing capital for 5 years. You're not pulling that out in any particular time. And that could have a competitive advantage for that fund over others with regards to what they're investing in, how they're investing in, the way the fund is vintaged out, etc.
Okay, so as we wrap up today's episode, why now? Why are alternative investments really something that if you've never thought about before, you might want to at least pay more attention to at the present?
Yeah, look, I mean, you do this when you're doing your expectations for withdrawal rates. What's the market premium expected to be? It most likely what you hear is it should be less, not more, over the next economic cycles in plural. And so, as investors, you're always looking for where are there rates of return that I'm not accessing. Frankly, that's what we ask ourselves all the time. That doesn't mean we do everything. In fact, we don't. But doesn't mean that you don't always ask yourself that and assess the landscape and the like, right? And so, the market dynamic, is the market risk premium going to be the same over the next 30 years than it was over the past 30 years? Probably not. And so you want to make sure that you're positioned to be able to capture, returns where they are. I mean, you don't see this internationally, but domestically, there hasn't been much of a small cap premium at all. Over the last investment cycle or so, some people attribute that to private equity. Companies don't need to go public as quickly. And because of private equity, you have, they can provide funding for these smaller companies for a significantly longer period of time that can have them stall going public, right? And so maybe private equity is a way to have access to this premium, that you could have gotten in a regular markets previously. Again, I'm just speaking in generalities right now, because someone can come back to me and say, well, the size premium has existed. It has existed internationally just fine over the last few years. But maybe that structure there from a private equity standpoint is different from the structure here, etc. The larger point being that there's, if there's lower expected returns in the public markets, then it's at least our job as an investment firm to scour the universe, right? No matter what. Inflationary concerns. We're still, even though inflation has been trending downward since COVID, we're still at a higher high than we were before. And so it behooves us to look into alternatives from an inflation hedging standpoint. Now, it's not just simply gold. In fact, I'm not a gold bug by any means. But real estate, residential real estate, timber, there's other areas that maybe provide a better hedge, if you will. And frankly, technological innovations are making things much easier to do. Like I said, if you can begin to turn alpha into beta by systematizing trading strategies and providing them liquid access to investors, then it becomes very interesting, from that vantage point. Because would I invest in every single alternative that's out there? No. But are there some that actually capture my attention as, hey, this is interesting, we should really look at this in a serious manner? Absolutely. Now, that would be a moot point if there was no way for our underlying investors to access that in a manner that we deem meets the criteria of liquidity and illiquidity, because I think that's quite important. That in a manner that meets the criteria for regulatory oversight, that's quite important. But the moment you create ETFs and liquid assets, guess what? Those things are under FINRA or the SEC. You know what I mean? They're under regulatory bodies. And so from that standpoint, that gives me great, relief from that standpoint. And then the minimums are just, going down from that standpoint because of the corollary that, they're making them tradable, they're making them more liquid, they're making them XYZ. When you do that, it just stands to reason that pricing does go down. And so to me, those are very interesting reasons of quote unquote why now you're seeing this growth of alternative investments.
Okay, so that's the introduction to the ARC. We'll be going into more depth on the different private equity and so forth in upcoming episodes. Before we wrap up today, we do have a listener question. Try to keep the habit of continuing with that. And so Alex, Vicky writes in, I do not have 40 credits needed to be eligible for Social Security, but my husband does. I just want to make sure that I understand correctly that the spousal benefit entitles me to receive 50% of his Social Security benefits if I file before he does. We're the same age, born 1 month apart. And yes, from the basic level of you do not need the 40 credits to qualify for a spousal benefit. So yes, generally speaking, you are entitled to 50%.
Wait, just for the interest, because people are listening in, can you define 40 credits?
The credits are that's for a quarter. You during each of the 4 quarters of a year, you earn enough, which it's like in the range of a couple $1,000s per quarter to qualify for credits. And so you basically need to have 10 years of Social Security covered earnings above a fairly minimal type level of a few $1,000s a year to achieve 40 credits to be eligible for your own worker benefit. So you do need the 40 credits to be eligible for a worker benefit. But if your spouse qualifies, you can receive spousal and survivor benefits without necessarily being eligible for your own worker benefit. So
I obviously knew that, Wade. I didn't ask for me. I asked for
okay.
our listening audience, not for me. I knew that, Wade. Just to
I'm sure you
reiterate,
did.
okay? I just want to reiterate, I knew that one.
Well, the point is, though, there are some. So generally speaking, you're eligible to 50% of your spouse's benefit, but there could be exceptions to that. A couple things is just based on claiming ages. Now, in this case, they're both about the same age. That makes things a bit simpler. But if you're claiming before your full retirement age, there's reduction factors based on the full retirement age primary insurance amount of your husband in this case. So, and also if your husband claimed early, he would have a reduction. And so and the reduction factors are different for spousal and worker benefits. So it might not line up to be precisely 50% in that scenario. In the other direction, if your husband delays past full retirement age, he'll get a higher benefit, but the spousal benefit is 50% of the primary insurance amount. So it does not get delay credits. You don't get any delay credits for waiting past your full retirement age, and you don't get any kind of quasi-delay credits from your spouse waiting past full retirement age. Now, the benefit of that spouse delaying, though, would be the survivor benefit would be higher, potentially someday. It's just the spousal benefit is linked to the full retirement age benefit. So that could be another possible reason why your spousal benefit isn't quite 50% of the husband's benefit. And again, that's because if he delayed past full retirement age. And the other thing is just their family maximums. So if your husband has other claimants on or other dependents on their benefit, maybe you still have minor children, maybe you're caring for parents who are eligible for dependent benefits, then you could hit that family maximum. And that could then reduce everyone's benefit to keep everyone under the family maximum. And so that could be another possible reason you're receiving less than 50%. And then if you're working, there's the earnings test before full retirement age that could lead you to not receive, after the earnings test, 50% of the benefit. But all that aside, yes, the general answer is you do not need 40 credits to receive a spousal benefit. And yes, at a very general level, spousal benefits are 50% of the worker's benefit. So thanks for writing in, Vicky.
Thank you, Vicky. Don't forget to check out the link. Vote on the paddle.
Right. Yeah, check out that Pickleball paddle link. And thanks everyone for listening. And we'll catch you next time. on Retire with Style.
Bye now.